Hello and welcome to the Global Dialogue. I'm Shereen Bhan. It is my absolute pleasure to welcome on the program Jenny Johnson, the Global CEO of Franklin Templeton. Jenny, what an absolute pleasure. Thank you so much for joining us here on the program. It's great to have you in India.
Well, thank you for having me on the program. It's a fantastic program, so I'm excited to be here.
Jenny, you've been a long-term observer of India. In fact, you spent about 6 months living here in India. So before I talk to you about what's happening in the world, let's talk about what's happening in India. What's the sense that you get? What's the feel that you get about the strength of the story, what it means in terms of fund flows potentially from here on?
I think India is the great possibility that just hadn't quite happened. And you feel like right now it's all coming together and happening. The demographics are phenomenal. 56% of the population is under the age of 25. You have some of the best schools in the world. So at the top tier level, phenomenal education. I think India graduates 6 times the number of engineers than the US does. The saying was always, India grows at night while the government sleeps. And it feels like we've gone from this kind of unorganized economic policies to a really organized economic policies to generate growth. And you're seeing that in the story. So of course, being in the asset management mutual fund business, right? The wealthier people get, the more they're able to save. And so we look at this growing middle class as just a massive expansion of the opportunity.
You talked about mutual funds and banks are facing a challenge saying, look, we're losing out on deposits because everyone's decided to go the mutual fund way. How are you reading what we've seen happen as far as that part of the story is concerned?
I think that's always been the case, right? Where people, when they first start saving, they put their money in a bank account. But ultimately, to achieve the true retirement goals that most people have, you actually have to get equity returns or even higher fixed income returns. So, the bank account's a great solution for a portion of your wealth. But to really accumulate and save, you have to be able to step into things like the equity markets.
So given the confidence in the India story, given the confidence in reforms that we are seeing at this point in time, what do you see in terms of fund flows? We've, of course, also got additional factors like the inclusion into the global bond index, which will potentially bring a lot more of foreign portfolio money into the country. How are you seeing foreign fund flows into India over the next few months?
The interesting thing is FDI into India has not been particularly high for a variety of reasons. Yeah. And I think that this is where organized economic policies matter. Gift City is going to be an important solution to that. And I think is designed specifically to bring flows in. So we, of course, as a global manager, are excited about participating in that and think it's a great way for our overseas investors to invest money into India.
You talked about overseas investors looking at India potentially at this point in time. What's looking exciting from a sectoral perspective? Private equity has been having a great run in India over the last few years as well. Where do you actually see the money coming in at this point in time? Are there any sectors where you believe that we could see disproportionate amounts of money coming in versus others?
I think that, first of all, private equity has had a great run globally. And I think part of that is because interest rates were so low globally. And it'll be interesting to see whether it has as strong of a run kind of in the next decade. Although, certainly what we're seeing in the U.S. is companies are waiting a lot longer to go public. So you're not seeing as many
the wait time is now, what, 14 years?
Yeah,
versus
14 or 15 years.
3 to 4 or 10 years ago?
Exactly. And so... and I think there's a lot of reasons why that is, but it's also, if your private equity was all about borrowing cheap and being able to invest in a company and trying to grow the company, that model's gotten a lot more difficult when money's more expensive. So I think that could be a little bit more challenging. But I think,
but that's a challenge for you as well, right? As an asset manager with less and less companies going public.
Oh, it's definitely a challenge. That's actually why we've done acquisitions in the private space, because we see secular trends both in the equity side where they're waiting longer to go public. So we want to participate in there. As a matter of fact, we got into the venture business in our growth equity team who started to do late stage venture because the old IPO deals that would give you kickers in performance were now happening in the private markets. And so we were able in the US to allocate up to 15% of a fund in illiquid assets. And so we started to do late stage venture there. Also, because banks have had capital requirements that have changed, you don't see banks lending in the same way, and that's created this massive private credit market. So I think those things are very real, and we look at it and say our job is to create a broad spectrum of capabilities for our clients along the risk spectrum, and be able to provide whatever solutions our clients are looking for. So private markets is an important part of that. And then I would just back to your original question about kind of where to invest. I think it's always better, I always say, to swim with the current. So you look at the big, broad opportunities. Energy transition is going to be an opportunity. I think everybody's really committed to that. Infrastructure, obviously the infrastructure that is being put in place by the support of the government is going to be important. Any kind of domestic consumption. The great opportunity in India is as you create wealth, people are going to be able to spend more in the domestic economy, and that's going to create opportunities. So again, kind of, think about what the broad trends are and then invest along with those.
Well, yeah, those are some of the trends that I think people are looking at and focused on at this point in time. But, Jenny, I want to talk about what you're seeing happen as far as valuations are concerned, especially in the private markets, and whether you have a view on what's happening in India, because we do have a fairly robust startup ecosystem, which is deep and broad today. But there has been this dissonance between public market and private market valuations. We've seen a recalibration and a reset, especially over the last 2 years. How are you reading that story?
It's interesting. I think we have a particularly good vantage point to look at that because we own an asset manager called Lexington Partners that does secondary private equity. And so they buy from limited partners of private equity holdings. They'll buy pieces of their pools of their investments because maybe they have liquidity needs or they've got a commitment to investing in another round of the private equity firm. So they want to reduce the amount of exposure they have on their in their portfolio. And what we're seeing is primary private equity is selling for about a 18 to 20% discount from where it's priced. And then real estate's kind of in the mid to high 70s. Late stage venture is probably at 50% discounts.
Wow.
And early stage ventures are essentially not being able to be acquired. So again, this is somewhat in the mature markets around. You see that phenomenon, and then you have to break it down. Real estate, office, people often don't even want to buy office. I mean, that's been. I don't know that we've seen the floor on office, but things like residential are still holding up pretty well. Logistics, data centers, those types of things are holding up pretty well. So, there's variations within. Now, that doesn't mean that the valuations are wrong. Part of that problem is that there's been $6 trillion deployed in private equity. There's only about 150 billion in secondary PE. And as you see less distributions and less realizations of those private equities, the limited partners who own that fund aren't getting the kind of cash flows that they have historically gotten. And so they're sitting there with an over allocation to private equity. So they need to sell it to a secondary manager. So that's been a real advantage. So it's as much a supply and demand as a valuation issue.
Jenny, let's talk a little bit about the India business and what you intend to do now in India. You ran into a fair amount of rough weather in 2021, to sort of put it mildly. But what kind of course correction have we seen you do post that to deal with the regulatory action that was taken and what the road ahead looks like now in terms of the cleanup?
Yeah. No, we were, the first foreign manager to set up in India in 1995, and a lot of folks followed us in and exited the markets, and we've been committed to the market for the 27 years and continue to be very committed to the market. And unfortunately, we did run in with COVID. We ran into real serious liquidity issues in our fixed income portfolios and had to make an incredibly difficult decision of closing down those funds to preserve value for clients. And the problem is you have a responsibility to both manage your clients' assets and give them good returns. And the good news is, since then, we have paid back almost 110% on average across the portfolios. But we didn't meet the liquidity needs that people had at those times. And that's a real shortfalling. But in order, again, to give kind of the fairness across all the investors, we made that tough decision, even though has been painful from a reputational standpoint. And a lot of people thought we'd exit India at that point. But again, looking at India from the long-term perspective, we think this is India's decade. I mean, if you think about it, last decade was China's decade. This is India's decade. And if it can keep doing what it's doing, it's going to be a phenomenal place for us to be as an asset manager. We've always loved India, but I think we're kind of at that hockey stick point of the growth where you've been growing the business here, but as that middle class takes off, I think that's what we're going to see in the next decade here.
You said that the speculation was that you would exit India. You haven't. You're here, and you're saying you're here to stay. What have been the lessons and the course correction post what happened in 2021?
Yeah, I mean, I think that the key is always communicating. As I said earlier, our job is to provide a series of products across the entire risk spectrum. So from very conservative fixed income to ultimately equities, aggressive equities, or even private markets in some cases. But the key is to communicate exactly what that looks like. And I always say to people, what we learned, because if you think about what's happened over the last couple of years, you had COVID, which basically froze up the fixed income markets globally. As a matter of fact, there was over 60 billion globally that were in funds that people had to close down because of the freezing of those markets. You've had 2 wars. You have the tension between the US and China. And it reminds you back to saying, you know what, those lessons of diversified portfolio, make sure you have a diversified portfolio because you never know when that next crazy thing that's going to happen. Franklin introduced SIPs into India. Yeah. That consistent investment, we call it dollar cost averaging. When the market's high, you're buying less shares. When it's low, you're buying more shares. Over time, you will average above. And that kind of discipline of staying in the market and keeping that discipline around investments, I think, is really important. And I just look at it and say the last couple of years, it's a reminder that those fundamental, tenets of investing still matter.